Good morning, students. In the previous lectures, we have studied Chapter 10 Government Budget and the Economy. We have studied about the meaning, features, and objectives of government budget. Today, we are going to start the topic Components of Budget. Component of budget refers to the structure of the budget. Two main components of budget are revenue budget and capital budget. Revenue budget, it deals with the revenue aspect of the government budget. It explains how revenue is generated or collected by the government and how it is allocated among various expenditure heads. Revenue budget has two parts: revenue receipts and revenue expenditures. In short, revenue budget shows revenue receipts and revenue expenditure of the government. Second one is capital budget. It deals with the capital aspect of the government budget and it consists of capital receipts and capital expenditure. In short, capital budget depicts capital receipts and capital expenditure of the government. The component of budget may also be looked at from a different angle. Two broad components are budget receipts and budget expenditure. Budget receipt includes revenue receipts and capital receipts, and budget expenditure includes revenue expenditure and capital expenditure. Students, firstly, we had studied, discussed that components of budget are revenue budget and capital budget. In revenue budget, further two parts, revenue receipts and revenue expenditure, means both are of revenue nature. Receipts and expenditures of revenue nature are included in the revenue budget. In capital budget, all type of capital transactions like capital receipts and capital expenditure. And in another way, the budget receipts and budget expenditure. In budget receipts, all types of receipts are included, either revenue receipts or capital receipts. Both are included in budget receipts. And in budget expenditure, both type of expenditures, revenue expenditure and capital expenditure, are included. In the today's lecture, we will discuss about the revenue receipts, and we will discuss tomorrow about the capital receipts and the budget expenditure. So let's start budget receipts. Budget receipts refers to the estimated money receipts of the government from all sources during a given fiscal year. Budget receipts may be further classified as revenue receipts and capital receipts. Revenue receipts. Revenue receipts may further classified as tax revenues and non-tax revenues, and capital receipts may further classified as recovery of loans, borrowings and other receipts. Listen, budget receipts refers to the estimated money receipts of the government from all sources during the fiscal year. Budget receipts are classified into two parts: revenue receipts and capital receipts. Revenue receipts. Revenue receipts are those money Revenue receipts are those money receipts of the government which satisfy the following two characteristics. First one is, these receipts do not create any liability for the government. It means tax receipts. For example, tax receipts. Tax receipts is a revenue receipt because it does not involve any corresponding liability for the government. Tax is a unilateral or one-sided compulsory payment to the government. When the government borrows from the public, it is not a revenue receipt. as it causes an increase in the liability for the government in terms of its repayment. Students, liability means we are liable to pay. But when government is collecting taxes, then it creates no liability. After that, second point, these receipts do not cause any reduction in the assets of the government. For example, when the government sells its shares of public companies, it causes reduction in the assets of the government. Assets means properties. These are therefore not be treated as revenue receipts. In short, revenue receipts of the government refers to those receipts which do not either create a liability or lead to reduction in assets. Like for example, government is selling his properties. So this cause reduction in the properties of the government, and this receipt is not known as revenue receipt because it is capital receipt. Then, sources of revenue receipts are tax revenues and non-tax revenues. Firstly, tax revenues. Tax revenues refers to the sum total of receipts from taxes and other duties imposed by the government. And non-tax revenues refers to the receipts of the government from all sources other than those of tax receipts. We will discuss tax revenues in detail. Tax revenues refers to the sum total of receipts from taxes and other duties imposed by the government. A tax is a compulsory payment made by a person or a firm to the government without reference to any benefit the payer may derive from the government. Types of taxes are direct taxes and indirect taxes. Direct taxes are those taxes which are paid by the same person on whom they have been imposed. Their tax burden cannot be shifted onto the other. For example, income tax is levied on individual persons on the income earned by them in a year. Every person who is liable to pay tax has himself to bear the burden of this tax. Similarly, corporation tax is levied on the profits of the company is paid by the company itself. Means direct taxes refer to the taxes that are imposed on property and income of individuals and companies and are paid directly by them to the government. Its impact, direct taxes are levied on individuals and companies. Shift of burden. The burden of shift tax cannot be shifted. That means impact and incidence is on the same person. Nature. They are generally progressive in nature. Coverage. They have limited reach as they do not reach all the sections of the economy. Next, we have indirect taxes. Indirect taxes refers to those taxes which affect the income and property of the individuals and company through their consumption expenditure. Its impact. Indirect taxes are levied on goods and services. Shift of burden. The burden of an indirect tax can be shifted. That means impact and incidence on different persons. Nature. They are generally proportional in nature. Coverage. They have a wide coverage as they reach all sections of the society. Let's understand the meaning of proportional taxes and progressive taxes. First of all, progressive taxes. Taxes in which the rate of tax increases as the tax base increases are called progressive taxes. For example, the government may fix tax rate at 10% for person earning between rupees 50,000 to rupees 1 lakh per annum and a tax rate of 15% for persons earning between rupees 1 lakh and rupees 2 lakh per annum. In such a situation, the richer person have to pay tax more than proportionately. Next, we have proportional taxes. Taxes in which the rate of tax remain constant, whatever the size of tax base may be, are called proportional taxes. For example, if rate of tax is 10%, then a person whose annual income is rupees 40,000 will have to pay rupees 4,000 per year as tax. But if income rises to rupees 60,000 per annum, the same percentage of tax will be collected from him irrespective of size of his income. He will now pay rupees 6,000 per year as tax. Next we have non-tax revenues. Non-tax revenues refers to receipt of the government from all sources other than those of tax receipts. Sources of non-tax revenues are interest, profits and dividends, fees, license fees, fines and penalties, escheat, gifts and grants, forfeitures, special assessment. Firstly, we have interest. Government receive interest on loans given by its state governments, union territories, private enterprises and general public. Interest receipts from those loans is an important source of non-tax revenue. Next we have profit and dividends. Government earn profits through public sector undertakings. It earns profit from the sale proceeds of the products of such public enterprises. Government also gets dividend from its investment in other companies. Next, we have fees. Fees refers to charges imposed by the government for services provided by it. Such services are generally in public interest. Fees are paid by those who receives services. Court fees, registration fees, passport fees, tuition fees in school, etc. are some examples of fees. Next we have license fees is a part of fees. Next we have fines and penalties. Government also get income by way of fines. For example, fine for lawbreakers such as crossing red lights, penalty for non-payment of tax, etc. Next we have escheats. It refers to claim of the government on the property of a person who dies without leaving behind any legal heir or a will. Next we have gifts and grants. Government receives financial help from within the country and abroad. This is generally received in times of natural calamities like floods, earthquake, or present example COVID-19. The contribution by us in the Prime Minister Relief Fund is a good example of gifts and grants. Next we have forfeitures. These are in form of penalties which are imposed by the courts for non-compliances of orders or non-fulfillment of contracts, etc. Lastly, we have special assessment. It refers to the payment made by the owners of those properties whose values has appreciated due to developmental activities of the government like construction of roads, setting up of metro stations, etc. For example, if value of property near a metro station has increased, then a part of developmental expenditure is recovered from owners of such property in form of special assessment. With this, the topic non-revenue, non-tax revenue is completed, and we were doing the sources of revenue receipts. This topic is completed. Tomorrow we will start the next capital receipts. So let's revise what we have done today in this lecture. Components of budget: revenue budget, capital budget, or we can classify it in another way: budget receipts and budget expenditures. In budget receipts, revenue receipts and capital receipts. In budget expenditure, revenue expenditure and capital expenditure, that we will discuss tomorrow. With this, today's topic is completed. So let's revise and read the whole chapter yourself and make your notes. Thank you.